International trade plays an important role in supporting countries' economic growth. Through international trade, countries are able to expand their markets, increase production, and strengthen their economies. However, trade activities are influenced by several factors such as trade policies, exchange rate movement, and global market conditions. Malaysia and Singapore share a very close and strategic trade relationship, mainly because they are neighboring countries. Singapore is one of Malaysia's major trading partners, even though they work closely together. Both countries have different economic structure and trade strategies. This makes Malaysia and Singapore suitable for comparison in international trade analysis. In recent time, there has been a strengthening of a Malaysian ringgit against the Singapore dollar. At the same time, global market volatility has increased due to the economic's uncertainty and changes in the monetary policies. These factors can affect export competitiveness, import costs, and the overall trade balance between the two countries. Therefore, this study focuses on comparing the international trade policies of Malaysia and Singapore and examine how exchange rates movement and market volatility influence their bilateral trade relationship.
Now, for the methodology, we started by collecting data from the World Bank, focusing on three indicators. First, the official exchange rate, LCU per US dollar, period average, which reflects the ringgit's value against the US dollar. Secondly, exports and imports, both in current US dollar, which directly influence the demand for the currency and, in turn, the exchange rate. Once we collected the data, it was transferred into Excel for preparation and analysis. The data included yearly figures for exchange rates, exports, and imports for both Malaysia and Singapore from 2019 to 2023. This helped organize the data into a usable format for the next steps. We created line graphs in Excel to visually represent the trends over time. These graphs showed the movements in the exchange rate alongside the changes in exports and imports. By visualizing this data, we could easily identify key trends such as how trade balances might be influencing the ringgit's performance against the Singapore dollar. Finally, the graph enabled us to identify the relationship between trade performance and exchange rate. By analyzing these patterns, we gain valuable insights into the economic factors that were affecting the exchange rate of the Malaysian ringgit over the years. In summary, the methodology involved collecting, preparing, visualizing, and analyzing the data. This approach allowed us to uncover insights into how trade influences the value of the ringgit against the Singapore dollar.
This graph shows the exchange rate trend of Malaysia and Singapore from 2019 to 2023. The Malaysian ringgit showed a gradual depreciation against the US dollar, indicating higher volatility compared to Singapore. In contrast, the Singapore dollar remains relatively stable, reflecting strong monetary management and economic stability.
The chart shows the annual inflation rate in Malaysia and Singapore from 2019 to 2023. In 2019, both countries experienced low inflation, indicating stable price. In 2020, inflation became negative in both Malaysia and Singapore due to reduced economic activity during the COVID-19 pandemic. As economies recovered in 2021, inflation increased in both countries. Inflation peaked in 2022, with Singapore recording a much higher rate than Malaysia, mainly because of rising global energy prices, supply chain disruption, and Singapore's reliance on import. In 2023, inflation declined in both countries, showing easing price pressure, although Singapore continued to have higher inflation than Malaysia.
This graph compares export, import, and trade balance between Malaysia and Singapore from 2019 to 2023. Malaysia maintained a moderate but consistent trade surplus, while Singapore records significantly higher trade volumes and stronger surplus, indicating a more export-oriented and open economy. Overall, the data analysis showed that exchange rate movement Market volatility and trade balance are closely related. A more stable market environment supports stronger currency performance and trade competitiveness.
In this section, the analysis of exchange rate, market volatility, and trade performance between Malaysia and Singapore in the period between 2019 and 2023 will be discussed as the key finding. The Malaysian ringgit was more volatile compared to the Singapore dollar. Although the ringgit showed some strengthen in recent year, it remained less stable overall. Fluctuations in exchange rate can affect export price. Import price may also change due to movement in the exchange rate, influencing trade costs. After that, the Singapore dollar was not significantly affected by the situation. This indicates effective economic management and sound monetary policy in Singapore. Malaysia experienced greater market volatility, especially during periods of global economic uncertainty. Both Malaysia and Singapore record trade surplus. However, Singapore total import and export are significantly higher than Malaysia. This helps explain why the Singapore dollar is in a stronger position compared to the Malaysia ringgit.
In conclusion, this study compares Malaysia and Singapore from 2019 to 2023 in terms of exchange rate movements and trade performance. The Malaysian ringgit experienced higher volatility, which created uncertainty in international trade and affected export competitiveness as well as import costs. In contrast, the Singapore dollar remained relatively stable due to strong monetary policy and a robust financial system. This stability reduced exchange rate risk and made Singapore more attractive to global investors and trading partners. Although both countries recorded trade surpluses, Singapore consistently showed higher trade volumes. Overall, the findings highlight that exchange rate stability plays an important role in enhancing a country's trade competitiveness, and Malaysia needs stronger economic resilience and policy consistency to improve its long-term trade performance.